Probably one of the most important videos I've made. I'm going to show you exactly how I built a six-figure portfolio from my trading profits and how I made it tax efficient. We're going to break down exactly how I ciphered my trading cash flow into a longer term portfolio, the system I still use till this day, the exact moves I made from how I scooped up S&P 500 and tech stocks cheap after Trump's inauguration, and then of course, most importantly, how I structured my portfolio for tax efficiency. So the first shift was understanding trading to wealth building. Trading is cash flow, but investing is wealth building. So every profitable month, I started withdrawing 20 to 30% of my trading profits and allocated it into the rest of my portfolio. Now, in the beginning, I actually did more than this. I did up to 50, 60, 70, 80% of my trading profits. And this is where the importance of having other businesses come from, so that everything I make from trading eventually I can give away to charity, I can give it to church, and I can throw it in my investment portfolio. So I'm going to show you exactly how I did this. Essentially, I started treating my trading accounts like feeder accounts into my investment portfolio. So the first thing you need to do is decide on your allocation strategy. You don't just want to invest into random investments. You want to have a clear structure that would balance growth, stability, and of course, tax efficiency. So I built my allocation around these three main principles: growth tilt with high conviction, core stability, and risk management for tax efficiency. So core stability is a foundation that compounds predictably over time. So my first priority was broad market exposure through the S&P 500 ETF and diversified equity ETFs like the JSE Top 40 in South Africa. So this gave me peace of mind. So even if I'm not trading or the market started slowing down, that my money's still working for me and it's not sitting in a bank doing nothing. Then once I had my core stability down, I started focusing on my growth tilt, where there's more high conviction plays. So I've always believed that in tech as long-term driver of my wealth, so tech stocks, AI stocks. So instead of chasing penny stocks or low caps, I started allocating a portion of my portfolio into established growth names like Tesla, Amazon, Facebook, Apple, NVIDIA, and these became long-term anchors that outperform month after month, year after year. Then, of course, to make sure that your portfolio can survive volatility, you need to include things like cash buffers, bonds, if you will. And on top of that, I use tax advantage accounts like your RA, your retirement annuity, or even better, maxing out your tax-free savings accounts every single year. In South Africa, you get 36,000 per year, tax-free, all interest tax-free, and 500k lifetimes, which we'll get into further into this video. So to maximize deductions, keep more of what I made, I invested into my RA and my TFSA, okay? So that way, after my tax returns were stronger without needing to take on more unnecessary risk. Then, allocating aggressively by understanding these two simple things: macroeconomics and market cycles. So here's the part that most people miss. Wealth isn't just about how much you invest, but also when and where you invest it, okay? So one of the moves I made was right after Donald Trump's inauguration in the beginning of 2025. So at the beginning of this year, Trump's inauguration, the markets were uncertain, many investors were fearful because of volatility, and the S&P 500 and tech stocks were trading at very attractive valuations compared to today. We saw the S&P 500 drop at least a good 20%, and that took down a lot of the large cap stocks that we were looking at. So I bought into the S&P 500 broad market ETF. I then started accumulating positions in the big tech stocks, and those positions multiply over years. If you just look at the S&P 500, it was at around $2,300 in early 2017, and in 2025 it's almost doubled. Okay, so tech stocks, things like Amazon, Tesla, Facebook, NVIDIA, these stocks went parabolic after Trump's inauguration and managed to get them down at a pretty good price. Okay, so the current allocation of my portfolio, and this is obviously going to change over time, this is obviously going to differentiate myself from your guys' portfolio. Everybody's portfolio is going to be different based on things like your goals, time horizon, your liquidity needs, whatever the case might be. I could take on a bit more risk, so I had more exposure towards things like crypto and equities, where a retiree is obviously not going to have that much exposure towards these high volatility markets. Okay, so current portfolio looks something like this, where we have core holdings in the S&P 500. I bought it super cheap, and I'll continue to dollar cost average every single month. Then I've got my growth assets, which are my large caps: Amazon, Microsoft, Apple, Nvidia, Google, Tesla, and then obviously some emerging market ETFs for diversification. At the moment, just JSE Top 40, and I will look to expand into things like China down the line. Okay, 20% crypto, BTC, which is my main driver. Occasionally, I'll rotate into altcoins with a bit of leverage if I see good opportunities on the lower time frame, or if I see the market's going to turn around, I can put on some shorts to hedge. But I'm treating this portfolio as a high-risk asymmetric upside play. Then, obviously, my retirement annuity. Try to reach up to 27.5% of my tax deduction each year. And this is also a tax shelter for me, and it's also a compounding engine. What I like about this is that it's money that I will never touch, and it's ensuring that my retirement is going to be smooth and sufficient. Okay. Then, of course, 10% cash and fixed income. I think everybody in their portfolio should have a bit of cash, whether it's in a high interest savings account. It just gives stability and reduces volatility of your portfolio, but also it acts as an emergency buffer, and also it's a potential allocation for future opportunities. You don't want to be locking up your funds into a 10-year annuity and then you see a good opportunity come down the line and you don't have funds to allocate, or you have to start withdrawing profits, get taxed on the profits, and it's just not going to be efficient. So let's talk a little bit about tax efficiency and how I optimize for tax efficiency. So the first thing is obviously exploring holding structures and trusts for future estate planning. So at the moment, having a private company, at least, and then setting that up with a trust, which is important for asset protection, but also estate duty efficiency. If you start building out a portfolio that's significant and you, for example, pass away, that you do have beneficiaries that you can pass down these funds to, and these funds don't just get locked up in an estate after you die. It becomes an administrative issue. So first things first, maxing out your tax-free savings account. As South Africans, we get 36,000 Rand per year contribution limit. All growth and withdrawals are completely tax-free, and I've done my ETFs inside my TFSA. You can also do dividend stocks, whatever the case might be. Your RA contributions, it's deductible of up to 27.5% of your taxable income, capped at 350K per year. It's an immediate tax refund, so you have more investable capital, and it's also long-term compounding inside the RA because it grows tax-free right until retirement. Okay. Then obviously things like offshore allocation. If you invest a portion of your offshore, you get that USD exposure, and this protects yourself against Rand appreciation. So this is something to pay attention to. And then, of course, capital gains management. So I try and hold my positions for a good couple of years. I've got a longer term mindset in play. I'm still young. Everything in my investment portfolio, I try not to touch. If I'm going to be touching and rebalancing too frequently, I'm going to be paying fees, I'm going to be paying taxes. So I want to try and minimize unnecessary trades in my investment account, and also lower the effective capital gains tax that I could be paying. So guys, this is the process that I'm using at the moment. This is exactly how I scaled up to my first 6-figure portfolio. I used my trading as a cash flow engine. I started treating it like a feeder account into my investment portfolio. I started deciding my allocation strategy, whereby I had my core stability first, my high conviction growth plays, and then I focused on things like my tax efficiency. Then I understood that I need to pay attention to things like market cycles and macroeconomics. In the case of early 2025, Trump's inauguration, we had the tariff implementation, the impact on imports and exports, which drove the stock market down into discount. So then we saw things like the S&P 500 and the top FANG stocks that were really, really cheap, allocated aggressively, And now we're back into all-time highs for majority of the plays. Tesla's about to hit all-time highs. JC top 40, S&P 500 all-time highs, Bitcoin all-time highs. Maxing out my TFSA. I've still got a cash portfolio in a high interest savings account, and I'm contributing to my retirement annuity for tax benefits. Then I've set up my P2I Limited. I have a trust for estate duty efficiency, and this is the process that I'm currently using to maximize tax efficiency, to currently build my portfolio, thinking about the long term, and how I'm using my trading profits as a feeder account to continuously feed my investment portfolio and ensure a solid and efficient retirement. So guys, if you use this process, make sure to visit a financial advisor first. My portfolio is not going to look the same as yours. If you guys do have any questions, make sure to send me a DM, like and subscribe, leave a comment down below, and I'll see you guys on the next video.